Following the post-pandemic rebound, many countries are now running into secondary economic problems. In the West, it's focused around spiking inflation and energy prices, whereas in China, it's more to do with slowing growth as it deflates the credit bubble that fueled the Chinese housing boom. So in this video, we look at the nature of those problems and the solutions that China's come up with, and we consider whether this represents an opportunity for investors. This video is sponsored by Noah, News Over Audio, which brings you the best in audio journalism. So now let's look at the Chinese economic problems and the crisis in 2022 in a bit more detail. Here's the problem. You can see straight away that the latest growth number was very poor for China. It was just 0.4% in Q2. That's well below the 5.5% target which China's set for this year, and also very low in comparison with growth before 2020, which was almost always above 6%. Now, if you don't believe the Chinese GDP numbers, a proxy for that is the price of copper, which you can see moves up and down pretty much in sync with Chinese GDP. And sure enough, over the course of 2022, after it peaked earlier in the year, you can see that copper prices have tanked. So China is facing a big growth problem this year. It's very unlikely to meet its target. And it's not just growth which is a problem. Remember, China's now a service-driven economy, so if its exports are floundering, then it has to rely on consumption within the country to pick up the slack. But retail sales were also weak in July. That was just a 2.7% year-on-year growth. Industrial output has also been weak. And whereas the overall unemployment number is only 5.4%, if you look at youth unemployment, that's very high at almost 20%. So make no mistake, China's got a growth crisis going on right now. Some of the economic problems in China have been exacerbated by its disastrous policy choices, such as zero COVID. Whereas in the West, we've learned to live with COVID and use vaccination to overcome the worst effects, China's instead decided to go for a zero COVID policy, where entire Tier 1 cities have been shut down due to an outbreak in the city. Now that's had a huge negative effect on GDP growth, particularly for those very productive Tier 1 cities. Fortunately, it does seem as if cases have now peaked. That happened just after the middle of August, according to these statistics. So hopefully that negative effect on GDP growth will start to wane over time. But if there is a secondary outbreak now, another wave of COVID, then again we could see shutdowns unless this policy changes. Another problem facing not just China but also Europe at the moment is drought. This is a map of rainfall in China. Notice how it's mostly in the southeast by the coast, but also in the northeast and the southwest. Whereas if you look at water consumption, that does occur in much of the same regions, but also in regions where there isn't a lot of available water resources. If you look at the difference between the two, you can see the regions of water stress. And this isn't a recent problem, this is data from 2010. So as China has urbanized, but also developed its industrial capacity, water resources haven't been able to meet demand. Now at some point that's going to limit productivity, and that's exacerbated by recent high temperatures and drought. And in places where a lot of energy comes from hydroelectric power, low water levels have meant that the capacity to generate electricity has been slashed. And in turn, companies like Toyota and Foxconn have had to cut production. So this has had a direct effect on Chinese productivity. And unless China finds a structural solution to this problem, it's going to be a problem in future as well. Another self-inflicted problem due to government policy is the tech wreck in China. If we compare a broad Chinese equity index, such as this MSCI China tracker, and that's shown in red, it pretty much hasn't moved since this data starts at the beginning of 2020. Whereas if we compare that with KWBP, which is the CraneShares China Internet Fund, that's been utterly disastrous since the beginning of 2021. And there are very few signs that that's recovered much after a bit of a false dawn in summer of 2022. And if we strip out state-owned enterprises, that's the blue line you can see here, again, that's been fairly disastrous over the course of this year. One of the companies which moved into the crosshairs of the Chinese Communist Party was Tencent, the games creator. And the latest profits from Tencent were very disappointing. In fact, it had a 56% year-on-year fall in Q2 profit. Now, that was partially due to a slowing Chinese economy, but also due to the regulatory crackdown by the government. Now, in the case of Tencent, that was a crackdown on gaming, so that when Tencent applies to release a new game, it gets very slow approval from the government. Also, the government decided that children should be restricted to just 3 hours of gameplay per week. Now, Tencent hasn't been static, it's changed its policy to adapt to this new environment, and it's done that by trying to expand abroad. But of course, that takes time. So that policy shift is going to take a while, and I'd expect to see poor profit growth until it starts to materialize. But this is by no means the only industry which has been affected. We've also seen it for companies like Alibaba. And although the government says it's backed down on some of those policy clampdowns, you can't really see it in the share price movement, at least not yet. In order to research this video, I used this article from the Telegraph, but narrated on the Noah app, or News Over Audio. Noah's not a breaking news app, instead it curates the very best in journalism from a variety of sources, many of which you'll find interesting as an investor, such as The Economist, Bloomberg, and the New York Times. Then Noah's editors, such as Oliver Fisk here, collate those stories into series which let you see the same story from multiple angles and triangulate on the truth. This is what the app looks like, and if you want to search for a particular topic, so for example China, these are all series to do with China. So for example, if you want to learn more about common prosperity as a policy, you can play the series. Now, as a viewer of PensionCraft, you get a special offer from Noah, such that you get 1 month of Noah Premium for free, and then it goes back to $7.99 per month thereafter. To learn more about that, just click on the link in the description below. Part of the housing problem in China has been over-leveraged property developers. Now, part of the problem is the model by which people buy houses in China. So if you want to buy a newly built house, as soon as you make the decision to buy a house, you have to pay for it immediately in full. What happens to the money then? Does it go into an escrow account to be kept safe? Well, actually, no. It goes directly into the coffers of a developer company, and then it can do whatever it wants with the money. In fact, it's often used as collateral for further lending, and that collateral can be used multiple times. Now, while house prices continue to rise and there's confidence in the market, everything is fine. But of course, that music has now stopped and the developers are running into problems. People just don't want to give them money up front for a property which they may not get. People are thinking, well, is this company going to go bust? Will they actually deliver the house which I've paid for in full? So the lack of confidence that developers will actually deliver a house has massively weakened growth in Chinese new builds. So this graphic from the FT shows tier 1 cities, that's this top band here. The size of the bubble represents the sales volume in a given city, and its position on the x-axis shows the year-on-year growth in sales relative to a year ago. So anything to the left of this 0 point represents a fall in year-on-year sales. So it's quite unusual for any of the tier 2 cities to actually have growing sales. And for some of the cities, the year-on-year growth has been catastrophic. It's fallen by 70% or more. And if we look at the average year-on-year growth, it's down by more than 40% in June. Now, a lot of local governments are funded by land sales to property development companies, so they're trying to stimulate sales of houses. So for example, in Henan province, which produces a lot of wheat and garlic, they've actually let farmers use garlic as a deposit on a house. I think that's a sign of the desperation which is currently around in the Chinese new build market. Now, given that about 20% of Chinese GDP, by some estimates, depends on the property development industry, this slowdown in Chinese property prices is going to have a very strong cooling effect on Chinese growth for some time to come. Another tail risk for investors in China is that it copies Russia and invades Taiwan. If that were to happen, then just like Russia, it would probably face international sanctions, and the economic impact of those sanctions would be absolutely huge. China's a much bigger part of the global economy than Russia, and its trade links are much more extensive. And as recently as August, it was simulating an attack in Taiwan with this live fire exercise in the Philippine Sea. Now that could just be saber rattling, but if it's not, and it's going to actually consider invading Taiwan, that would be catastrophic for investors in China. Now, fortunately, China's particularly dependent on Taiwan for integrated circuits. And Taiwan Semiconductor Manufacturing Company on its own accounts for half of the global foundry market in chips. So it is very difficult for China to find an alternative supplier, and it is trying to develop its own chips, but they're a generation behind those in Taiwan. Now, the speed of the chips depend on the size of the etchings on the silicon wafers, and Taiwan creates the latest generation, and these are called 5 nanometer and 7 nanometer chips. So perhaps eventually China can reproduce its own version of very advanced chips, but certainly not for now. So hopefully the possibility of international sanctions and its dependence on trade with Taiwan means that it won't invade. The Chinese government is of course aware of these problems, so it has created some stimulus to try and soften the blow. And its most recent policy from the central bank, the People's Bank of China, has been to cut the loan prime rate. And the one linked to most mortgages in China is the 5-year rate, which you can see has dropped here very sharply. And consequently, the Chinese mortgage funding rate has also dropped very sharply. So hopefully that'll stimulate the Chinese property market. But it does mean that China's pedaling in the opposite direction to most central banks, which are trying to stave off really high inflation. So this might in turn cause problems for China's currency, which would weaken relative to countries which have hiked rates. And if we look at Chinese developer stocks, after that LPR cut, you can see that it's had a slightly stimulative effect, but it's very early days so far. Now, it's not all negative, there are some signs of hope. So if we look at the purchasing manager indices, which are a leading indicator of Chinese growth, and these usually split into services and manufacturing, services is now very important in China, and you can see that that has bounced back. And in fact, it's well above 50, which is a sign of expansion. And if you drill into the PMI report, they talk about things such as looser pandemic restrictions, increasing that index. And certainly new orders have been brisk. Those have risen at a faster pace in July. However, here too, there are problems from the pandemic abroad. You can see that the pandemics continue to dampen foreign demand for Chinese goods and services. And China also faces higher input costs, just as companies do in the West. If we look at the manufacturing index, that's not so positive. That slid back slightly in July, and that was due to slower upturns in output and total new work, but also muted customer demand. And that's due to COVID-19 impacts, but also that power supply disruption problem that we saw earlier. Now, I made a video about Jeremy Grantham's views recently, and one of the things which he likes is emerging market value stocks. And his company, which is GMO, has produced this 7-year outlook for returns across different asset classes. Now, notice that the highest return over the next 7 years, at 7.9% per year, is for emerging market value stocks. Now, these are real returns, and if we compare that with the US, their GMO expects negative real returns for US large caps, but also US small caps over the next 7 years. International stocks aren't as bad, so 2.5 for international large, 4% for international small caps, and 4.7% for emerging overall. And it's certainly true that when stocks are cheap, they tend to give the highest returns, assuming there isn't a huge systemic problem which lasts a decade, say. And China is very cheap. If we look at the CAPE measure, the cyclically adjusted price to earnings ratio, the US is still looking very expensive, whereas the UK and China look very cheap, both by historical standards, but also relative to other countries. In conclusion then, the effects of the disastrous zero COVID policy are starting to weaken as the outbreaks start to fade. The other positive is that Chinese equity is very cheap by historic standards, but also compared to other countries. That in turn means that if you do buy now, in theory, it should give you better long-term returns. If we switch to the negatives, we can see that demand for exports will probably weaken as recession grips much of the West. Also, many of the structural problems in the housing market in China are still in place. Cutting interest rates is not going to solve the problem of oversupply. And also, I can't see any stimulus for growth, so I expect Chinese growth will remain weak for some time to come. So I'm not convinced that now's a great time to invest in China. I think a lot of the problems which it faces have not been resolved, particularly how's it going to shrink that credit bubble without imploding growth. That doesn't seem to be addressed by current policies. Maybe it'll come out with a big stimulus, but that hasn't happened yet. Now, if you are going to hold it for maybe 10, 20 years, valuations do make it attractive if you think it can see its way through this kind of economic morass. Now, don't forget our offer from Noah, News Over Audio. You'll find a link to that in the description of the video. And as always, thank you for listening.